If you've ever wondered whether your financial advisor is actually looking out for you, or if they're just collecting fees while doing the bare minimum, this video is for you. Today, we're going to dive into 10 reasons why it might be time to fire your financial advisor. Trust me, by the end of this video, you'll know if it's time to make the switch. So let's get started with the first reason. Reason number 1, you're paying an annual ongoing fee but only meet with them once or twice a year. Here's the thing, if you're paying a fee, whether it's a percentage of your assets or a monthly subscription, you should be getting value throughout the entire year. But if you only meet with your advisor once or twice, you have to ask yourself, what are they doing the other 363 days? Your advisor should be proactive, constantly updating your financial plan, bringing tax-saving ideas to the table, and helping you adjust as your life changes. If they're just managing your money and not doing much else, that's a red flag. After all, money doesn't need to be managed every single day. A solid strategy with low-cost index funds or ETFs that's rebalanced once a year can outperform most actively managed accounts over time. With technology, investing is easier than ever. The real value your advisor provides should go way beyond picking stocks. Reason number 2, they're not giving you comprehensive advice. A good financial advisor should help you with your entire financial life. Income, expenses, taxes, retirement goals, charitable giving, insurance, you name it. If they're only focused on your portfolio, you're missing out on some huge opportunities to improve your financial situation. For example, if you're nearing retirement and your advisor hasn't discussed Social Security strategies, how to minimize taxes on your withdrawals, or whether Roth conversions make sense for you, that's a major opportunity missed. Same goes if you're saving for your kids' college education and they aren't helping you navigate the pros and cons of 529 plans or custodial accounts. Financial planning isn't just about growing your money, it's about making sure your plan fits your life. Reason number 3, you rarely hear from them unless they're selling you something. Your advisor should be reaching out regularly to talk about your financial progress and update your plan, not just when they're trying to sell you a new product. If the only time you hear from them is when they're recommending something like an annuity or a high-fee mutual fund, that's a problem. Commission-based products like certain annuities or insurance policies often come with high fees that may not be in your best interest. I'm not bashing all annuities or insurance products, but you need to know exactly what you're getting. If they tell you there's no cost, the fee is usually the surrender charges if you end the contract early, or the spread between what you're earning and what the insurance company is making off the contract. Reason number 4, you don't understand how you're invested or why. You should never feel like you're in the dark when it comes to how your money is invested. It's your money after all, and you deserve to know how it's working for you. You should have a clear understanding of your investment strategy, asset allocation, and, just as importantly, why certain investments were placed in specific accounts. If your advisor can't explain this to you in a way that makes sense, that's a red flag. Complexity without clarity can often mask higher fees, unnecessary risks, or even investments that aren't appropriate for your goals. Remember, simplicity is usually the best strategy for most investors. Often, advisors add layers of complexity to make themselves seem indispensable. The more confusing they make it sound, the more likely you'll think you need them to manage it for you. Example, let's say you ask your advisor why your portfolio contains several high-fee mutual funds, and instead of a straightforward answer, they start throwing jargon at you, terms like alpha, beta, Sharpe ratio, and you're left feeling more confused than before. They dodge your questions, and you still don't know what role each investment is playing in your overall strategy. If you find yourself in this situation, it might be time to rethink your relationship with that advisor. A good advisor should be able to break down your investments in a way that's easy to understand. If they can't, they may be adding complexity to justify their own role, and that's not in your best interest. Reason number 5, your advisor doesn't listen to your goals. Financial planning is personal, and your advisor should be building a plan around what matters to you. If you want to retire early, buy a second home, or leave a legacy, your advisor should listen and tailor their advice to help you achieve those goals. A common issue with larger firms is they tend to put clients into boxes based on generic questionnaires or algorithms instead of truly listening to what you want. For example, you might want a higher allocation to equities because you're comfortable with more risk, but their system says you should have a more conservative mix. Rather than adjusting to your unique preferences and goals, they stick you with a one-size-fits-all portfolio that doesn't really reflect where you want to go. If they're forcing you into a predetermined asset allocation based on an algorithm or questionnaire, instead of focusing on your personal needs, they're not working for you. Reason number 6, you hold bonds in your taxable account. This one can be controversial, but hear me out. Taxes are one of the biggest lifetime expenses, and your advisor should be minimizing them. If you're holding bonds in a taxable account, your advisor might be ignoring the tax implications. Bonds generate taxable income, and if that's being taxed at your marginal rate, say 24%, you're losing out. Instead, if you held stocks in your taxable account, you'd pay long-term capital gains taxes, which are typically around 15%. That's a big difference that can add up over time. Reason number 7, they charge based on your asset level. Advisors who charge a percentage of your assets might seem like they're aligning their success with yours, but it can get unfair quickly. Let's say you have a $2 million portfolio and your advisor is charging 1%, so you're paying $20,000 per year. Meanwhile, your friend has $1 million invested with the same advisor and is paying $10,000 a year for what is essentially the same service. Same advice, same level of attention, but you're paying double. How is that fair? It gets even more extreme when you come into additional money. Let's say you inherit $2 million from a relative or sell a business for the same amount. Now your advisor is managing $4 million of your money and your annual fee skyrockets to $40,000 just because you've added more funds. But here's the kicker. Is it really that much more work for your advisor to manage the additional assets? Likely not. Managing $4 million isn't twice the work of managing $2 million, yet you're now paying double the fee. This type of pricing structure often feels outdated and unjustified. If your advisor charges based on AUM, it's worth considering if you're truly getting your money's worth, especially if your fees keep climbing as your wealth grows without any corresponding increase in service. Reason number 8, they promise guaranteed returns or unrealistically high results. No one can guarantee returns in the stock market, period. If your advisor is promising you double-digit returns, it's a major red flag. They might be trying to sell you something risky or misleading you to get your business. Trustworthy advisors will set realistic expectations and help you navigate the ups and downs of the market. Reason number 9, they don't recommend low-cost index funds or ETFs. Low-cost index funds and ETFs are some of the best tools for investors. They offer broad diversification at a fraction of the cost of actively managed funds. If your advisor isn't recommending these, they might be pushing high-fee mutual funds or commission-based products instead, ones that may not perform any better but are more expensive for you. If your advisor is recommending a mutual fund with a 1 to 2% expense ratio, that means you're paying that much in fees every year, regardless of how the fund performs. Meanwhile, a low-cost index fund might have an expense ratio of just 0.03%. Over time, that difference in fees can really add up, and in many cases, the actively managed fund won't even outperform the index fund. A good advisor should be looking for ways to save you money, not just recommending investments that generate higher commissions for them. If they aren't talking to you about low-cost index funds or ETFs, they might not be acting in your best financial interest. Reason number 10, they add bonds to your Roth IRA. Placing bonds in a Roth IRA is one of those seemingly small mistakes that can have big consequences down the road. Some advisors do this because, as I mentioned before, they don't want bonds in a taxable account where the interest is subject to higher taxes. But here's the problem. Placing bonds in a Roth IRA wastes one of the most valuable features of that account, tax-free growth. Bonds typically offer lower returns compared to stocks, so by putting them in a Roth IRA, you're missing out on maximizing the tax-free growth potential that stocks provide. These kinds of placement errors can cost you and your heirs significant wealth over time. A Roth IRA is a fantastic tool for building tax-free growth, and bonds, while stable, don't take full advantage of that benefit. More often than not, if you see bonds in your Roth IRA, It's because your advisor is trying to fit you into some predetermined asset allocation model or algorithm that their firm uses. They might be trying to hit a specific bond-to-stock ratio without considering the unique benefits of different account types. A good advisor should customize your asset allocation based on your individual needs and the types of accounts you hold, not just plug you into a one-size-fits-all strategy. If any of these reasons sound familiar, it might be time to rethink your relationship with your advisor. Your financial advisor should be working for you, not the other way around. If you're unsure about what steps to take next, I can help. Schedule a free consultation at The Hourly Advisor, and together we'll figure out the best path forward for your financial future.